Thank you very much, Brian, and welcome to everyone. Welcome to all our panelists. Thank you very much for your time to join us, and Tina joining virtually as well. Welcome. Hello, Tina. Good to see you there. Stablecoins are one of the most fascinating and important aspects of the cryptocurrency world, and over the last couple of years, this technology has really developed in a way that has meant that traditional industries, as well as cryptocurrency companies, policymakers, regulators across the world have really started to take notice and think about the myriad implications of the rise of stablecoins. And I really wanted to start today's discussion with our panelists just to talk about an overview of exactly where we are at the moment. When it comes to stablecoins, it's been over a decade since Bitcoin was launched. Stablecoins have been around for slightly less than that, but I think it's very fair to say that many of the most prominent stablecoins are extremely important cogs in the wider cryptocurrency ecosystem. So, Andrea, if I could start with you, please. What do you see the current position of stablecoins in the wider cryptocurrency landscape in December 2022?
So, first of all, thank you for having me in this panel. It's a pleasure. That's a difficult question because the ecosystem continues to evolve very, very fast. And if we can sort of approximate the fact that stable coins were created partially to park money for crypto traders and so on, then I think there's been an evolution of their role and of their potential, which is yet to be fully exploited, in my view. I'm thinking of stablecoins going much more mainstream and be embedded into the financial system, perhaps as an issuance from banks or as a bridge across different worlds in the payment system. The issue is clearly we've gone from a proliferation phase to a heavy rationalization phase, call it crypto winter or whatever. And perhaps this can be sort of cathartic moment that also allows to rethink and redefine the role of stablecoins, and not just being a niche, but becoming a tool and a bridge to give access to new services and payments to a wider public, and probably for a much wider scope.
Yeah. Tina, good afternoon to you. As representative of Circle, one of the issuers of the USDC coin, I think you're in a great position to be able to speak to this wider question of exactly how stablecoins this year have started to emerge from a primarily cryptocurrency-based technology, something which maybe touches on traditional industries, the world of traditional currencies, and so on. How do you see the development of stablecoins this year?
Yeah, that's a great question, Tom. So I think from Circle's perspective, moving from that speculation phase in the crypto capital markets to more utility phase is certainly underway now. We've seen an incredible increase in the payments use case, and that might be through traditional financial partners like WorldPay or FIS, Checkout, for example, Visa, MasterCard, all work with Circle using USDC as a settlement asset, which is significantly faster, in many cases significantly cheaper, and offers greater level of transparency. In addition to that, I think this year especially, we've seen some of the use cases around cross-border remittances and humanitarian aid really come to the forefront, especially in light of Ukraine. So I assume many people in the room will be aware that literally hundreds of millions of dollars were raised for the Ukrainian both war effort and humanitarian aid through cryptocurrency. And working with some of our charity partners, we have been able to kind of accelerate those the distribution of that aid that comes from maybe more traditional sources than your individual person that might be donating cryptocurrency. And so I think with that immediate need came almost an inadvertent proof of concept to be able to demonstrate how effective and efficient humanitarian aid payments could be, and indeed the ability to kind of track and trace the placement of those funds, the source of funds, et cetera, has been quite transformational.
I think it's a really interesting point. And Jeff, if I could bring you in here, you've focused heavily on central bank digital currencies. Stablecoins, at the moment, December 2022, why would I go out and use a stablecoin to buy goods or services instead of pounds, dollars, euros?
Well, I think the first the first explanation is that it's because we don't have CBDC yet. Although I think that there are some structural reasons for that, and there are also some opportunities for stablecoin issuance. And I think that even after we get CBDC, there will still be a role for stablecoins. And let me be clear about what I mean. Banks issue stablecoins de facto already, economically speaking. When banks create bank accounts for people, basically, the money that's held in bank accounts is not central bank money, right? I mean, it's not actually held. Central bank money is not held in bank accounts. Let's be clear. I mean, people give central bank money to the bank, and then the bank issues them basically the stable coins of their institution. That happens right now. And now, yes, governments have smoothed it over by using deposit insurance and making these channels available and such. But make no mistake, these are effectively the coins of these institutions already. So at some level, we've already got it. Now, let's be clear about the difference between stable coins and CBDC. If I hold a stable coin and the responsible party for the stable coin blows up, goes bankrupt, then either it's backed by the central bank or it's not. And if it's backed by the central bank, whether or not the central bank issued it, it's CBDC. And if it's not backed by the central bank, then it's not the same. There's a risk. There's a risk premium, this possibility that the central bank won't pay it, won't pay it back, won't refinance won't cover the value of this coin. And in that case, it must not be stable, actually. And when I say that, what I mean is it must trade at a discount. So at some level, stable coins are intrinsically problematic. They have this intrinsic risk. Now we can imagine using the same kind of deposit insurance approach. We can say, well, people who hold the stable coin, they give me a valid coin, even though it's worth nothing, and the government backs it up by a fiscal policy and all that. We can imagine that, and that's possible. If we're in the payments world and we imagine that stable coins would be used for payments, then that's valid. But I would say that this is actually the crux of the use case for stablecoins that we've been missing. I mean, yes, we've been talking about some of the ones that Andrea mentioned, but ultimately, what's going on is that in this digital world, we have this increasing reliance on electronic payments to do everything. It's hard to buy a cup of coffee at some shops in central London with cash, and that's a real problem. Stablecoins can help because they can actually provide a digital instrument that, unlike a bank deposit, is actually in my possession, under my control, and can potentially deliver privacy if it's implemented correctly. These are characteristics that don't apply to traditional bank deposits that we're missing. And I think we get to this point when we say, well, stablecoins are digital currency after all, and digital currency has great potential. And when we talk of digital payments and people visualize us going from cash to digital cash, that's not really what we have right now, but it could be if we have stablecoins. That's all.
So we're at this fascinating point, thank you, Jeff, that stablecoins present a tantalizing prospect for quite a revolution in how we transact, how we buy goods and services, how money flows across the world. And James, if I could bring you in here, from a regulatory point of view, what do you see as some of the most prominent risks of a situation in which, as Jeff has described, and as Tina has described is already happening, we see a real widening and deepening of the use of stablecoins from a point of view of a financial regulator? What would you what are you most concerned about?
So thank you, and thank you for inviting me here. I'm concerned about all sorts of things when it comes to crypto assets and stablecoins. Just to give a bit of background, stablecoins are not currently within the FCA regulation, although Treasury has committed to bringing it into the FCA perimeter next year. As with any crypto assets, if it's not truly stable, then there is a risk that you will lose all your money. If stablecoins are, as it says on the tin, stable, then there are huge potential there for different use cases across payments, for faster transactions. And as Tina said, there's all sorts of different use cases that could be there. But from my perspective, and I have to go to the negative because I'm a regulator, there needs to be consumer protection, there needs to be market integrity, and regulation will play a part in that.
Thank you. And Tina, what do you make of that? There are concerns about the stability of stable coins and so on. And from the industry, I just wonder what kind of steps you take, how you communicate, how you attempt to set the narrative that inflection products are stable and do what they say on the tin. What kind of words do you use to assuage the concerns of regulators?
Yeah, no, I think Jane and Jeff both make excellent points. We actually don't refer to USDC or our European backed token Eurocoin as stablecoins. Personally, I think it's the worst, taxonomy that crypto has come up with. And there's been, some significantly bad taxonomies around. So we really see USDC and Eurocoin as digital currencies. And within that, there are a number of tokens that purport to be stablecoins or, have a mechanism to provide that stabilization function that we've, seen this year indeed crash and burn, pretty dramatically. And so, I'm not going to say that never in the future could there be a stable token that could be stabilized with some kind of algorithmic basket, mechanism. But today, we have not seen evidence of that. So Circle is incredibly conservative, and in some ways, from a digital asset perspective, incredibly boring. So we take in deposits, or people send us cash, and we put it in a bank account, and it sits there. It does nothing. We don't lend it. We don't hypothecate it in any way. We do attestations and audits. Anybody can go on to the SEC's website. We are in the process of becoming a public company and see our audited financials. We do hold for USDC some reserves in Treasury bonds, the most conservative, redeemable in 30 days. And we've started publishing our SIS number, so you can go in and see exactly what those treasuries are. And so within that, I think there's the reserve model that I think is pretty critical, like how you're holding your reserves and what types of high quality liquid assets you might be holding those reserves, that they're auditable and fully transparent at all times. But in addition to that, and I think that we've seen over the course of the last couple of weeks, there's a significant amount of governance and compliance and risk management that goes into running any company, and certainly a financial services company. And so, we put in place all of those mechanisms, and I'm sure lots of people say that they do. We're able to prove that we do. Because ultimately, as Jeff said, if it doesn't maintain a stable value and people can't trust that it's a stable value, then it's useless for a payments use case, right? Which is why we don't really use things like Bitcoin for payments today. The one thing I would say, though, is that the USDC is going to be as stable, or any fiat-backed token is going to be as stable as the currency that it is underpinned with. And central bank digital currencies around the world, not necessarily the dollar, but we've seen quite a lot of fluctuation in the pound over the last couple of months. And so for us, that it is one for one. Your euro coin or your USDC will always be worth $1. But ultimately, what's $1 worth, right? And I think that is one thing that we need to keep in mind when we kind of compare CBDCs with privately issued stablecoins.
That's an absolutely great question. I'd just like to bring in Andrea. This year in the spring, May, June, we had the downfall of Terra USD, and it seemed to me that this was one of the prime examples of where a stablecoin or the decline of a stablecoin can impact stability quite contained in a particular industry. But if I may, I would like to ask from the point of view of traditional finance, how do you see the increasing interaction between stablecoins which are out there, USDC, Terra USD, Binance USD, and both crypto industry as well as the wider financial world out there?
Yeah, so listening to my co-panelists, it feels to me like the conversation is converging more and more towards the regulated world. We have more and more self-regulation, sort of self-imposition in the digital currency space to create trust or try to recreate trust. And at the same time, regulators being concerned about the lack of regulation and the risks for the wider public that get more involved into the space. So it feels to me like the irony or the paradox of the dynamic we've seen in the evolution of the industry is that we started with a contraposition of the creative, free crypto world that want to just experiment and innovate, and regulation seen as the worst evil. I think the paradox is that regulation will save the space and possibly make it thrive, because in the end, when I hear the points of validity of a good stablecoin, they sound very, very much like regulated entities that hold cash and short-term treasuries as reserves that take undue risks, that have got adequate governance and auditing and so on. That's what regulation is about. And ultimately, what Jeff was saying before about the fact that banks de facto issue digital currency, have been doing so for many decades now. It's absolutely true. I subscribe to that. And the only difference in people's minds between current account, private currency, and a digital currency is just the mental link of the deposit insurance scheme, the fact that banks have been bailed out, and the fact that people have hardly ever lost money holding cash in a regulated bank. So in the end, I think there is a point to be made here that the initial contrast between freedom and innovation and so on and regulation is actually converging towards a rationalization phase, whereby if the industry wants to expand, thrive, and prosper, it needs to be regulated.
Yeah.
Could I just add something to that?
Just one second, please. Just so I'm bringing Jeff in. I wanted to ask, from the neutral observer's point of view, things like Terra USD and the ructions that this caused in crypto markets this year, which hastened the downfall of several cryptocurrency companies. To what extent are there fears that this kind of instability that we've seen in the crypto world, which has been linked to self-declared stablecoin, whether or not it actually fulfills those claims is another matter. But I just wonder, what are the prospects of this actually washing over into the wider real economy, the economy of London out there, and if a stablecoin was more widely used, what kind of risks would there be of that happen?
Right. So I think there are two ways to look at this. Number one is that we have that the cryptocurrency world, of which the stablecoins world is only a subset, is quite small. And as we know, if there is a cryptocurrency eruption, not only is it tethered to the economy, no pun intended, but not only are risk assets always correlated with each other, as we've discovered the hard way again and again through history, but ultimately it's not so much that this asset has an impact on the broader economy, but that the broader economy has an impact on this asset. For example, if risk assets are being de-risked in a deleveraging, and leveraged investments into crypto assets are exposed, then they will also lose value. So one way to look at it is this relationship with the broader market and the correlations that are intrinsic to any risk assets. The other, I think, angle on this is this question of how it's used. And for that, I'd like to take a step back and think, well, and guide us to this question of whether we've seen this before. And the answer is yes, right? Banks have been exposed intrinsically to this kind of risk, bank runs and the like. This is not new structurally. And if we look at the kinds of regulations that have been introduced and the kinds of procedures, both fiscal and regulatory in other contexts, we can imagine that the future might well involve appropriate measures taken to achieve the kinds of outcomes that we want. So in particular, I wanted to respond to Tiara when she had said that Tina, forgive me, sorry about that, Tina. I wanted to respond to Tina saying, when she said that the stablecoin will be as stable as the currency that underpins it. That's not really true. And the reason that it's not really true is that ultimately whoever is the issuer of a stablecoin has a responsibility, and they might fail to fulfill that responsibility. Whether they back it with tokens in a vault or gold or banknotes issued by the central bank, there might be a lot of reasons in which ultimately they will fail to deliver on this. It might simply be that they failed to take the action that they were required to take and that they were the only party who could do it. And if that's the case, then it's not quite the same. But the good news is that it can be as good as it needs to be for its purposes. And in the case of payments with relatively small values, we can imagine using the kinds of deposit schemes that exist for deposit insurance schemes that exist for bank deposits that could be applied to stablecoins. You could make a claim on a particular stablecoin up to a certain value per taxpayer ID and receive your fiscal remuneration from the central government and be happy with that. And maybe that's good enough. But we would need to establish these kinds of mechanisms and understand what the difference is between stablecoins and other forms of bank issued money that are subject to other conditions, in particular custody. And if we look at the value of digital currency being precisely the value of self-custody, then we can imagine a different regulatory framework, but no less important, but a different regulatory framework for stablecoins. Thanks.
Thank you ever so much. I think it's a fascinating point. And Tina, if I may bring you back in here, I think essentially the thrust of Jeff and Andrea's points were that governance is only essentially at present as good as what the issuer says it is. It seems to me at the moment there is a large degree of self-regulation going on in the absence of clearer rules in the crypto world. Just very quickly, if I may, before we move on to the wider point of regulation, from the point of view of companies which are issuing these tokens, what kind of standards should the industry hold itself to, and how good a job is it actually doing at this point?
Yeah, that's a great question. I think I will answer that by, I think, hopefully kind of addressing some of the earlier points that were made by my colleagues. I think the first is when you're looking at issuers today, there's a variety of different types of entities that are issuing stablecoins. And just to be clear, when I'm talking about stablecoins, I'm very specifically speaking about fiat-backed tokens. I'm not talking about gold. I'm not talking about a basket. I'm being very specific here. There are some exchanges that also issue stablecoins. You mentioned a couple of them earlier. Circle doesn't have a trading platform. We only issue stablecoins. And so, I think that as we start to look at governance mechanisms, I think there are some concerns, especially when you look at the collapse of FTX, kind of the unring fencing or, the cross-pollination of activities in one platform, to me, it raises some issues around, potential conduct issues. And certainly, yeah, I mean, I'm not convinced that exchanges should be issuing their own stablecoins. Circle is regulated in the US under money transmission licenses. We also are very active advocates for regulation around the world. We spend a lot of time, it's my full-time job. But in addition to that, we're very supportive and driving of prudential regulation. So, there are proposals, and I'm sure Jane will probably, speak to some of those later around how the FCA might bring stablecoins into the regulated perimeter. We're very supportive of that being at that prudential level and all of the governance and regulatory obligations that come with that. I think the other thing to just kind of address is that stablecoins are indeed different to bank issued money for a number of reasons. Banks lend deposits, Circle doesn't. We don't create credit. And I think that when you look at USDC and the convergence around, becoming more like, regulated financial services, to my colleague's point, I think he's right. USDC looks a lot less like crypto and certainly more like traditional e-money. Now, the difference there between, this type of privately issued e-money and other types of e-money are that stablecoins run on open source blockchain networks. And so they're inherently more interoperable cross-chain. Circle operates across 15. And they provide a level of transparency that, some of the other traditional e-money is just unable to do because it's running on closed networks. And that stablecoins, because of their kind of digitally native design, they are, inherently internet ready and therefore are able to kind of accelerate the movement of value as we accelerate toward kind of the Web3 environment where, I think it's possible that CBDCs will also be able to do that. But today, most CBDC designs are not really considering open source networks. And so that really begs the question of why? Why would you bother? But I think you're absolutely right. If you're touching fiat money, you should be regulated and there should be guardrails and the conflicts of interest between other activities that some of the other stablecoin issuers do, in addition to issuing their stablecoins, I think conflates risk.
It's a fascinating point. And Jane, if I could turn to you in terms of regulations at the moment across the world, we're seeing countries, governments everywhere trying to work out how to deal with cryptocurrencies as a whole. 2024, it looks like the MiCA rules will be in place in the European Union. Other major economies, such as Japan, of course, have developed rules much earlier, which some say already is starting to look a bit out of date. What are the key challenges in trying to work out how to regulate stablecoins as and when the FCA actually receives the power to craft regulations for this? I just wanted to hear your views on what some of the biggest challenges are with actually drawing up a set of rules which essentially get after a moving target, which can change from year to year very quickly.
That's an excellent question. It is a moving target. So where we are on regulation of stablecoin, and I'm talking here, as Tina is, about fiat-backed stablecoins, which can be used for payments, can be used for other things. We are looking at it from a technology neutral perspective. There are benefits of the technology without doubt, but we're not looking to regulate the technology, we're looking to regulate the activities. as we do any other financial services activities. And we are proceeding on a basis which Treasury has set out publicly of same risk, same regulatory outcome. So we are looking at the MiCA proposals, we're looking at the international proposals, and we're working internationally as well. I think one of the biggest challenges is the international nature of the firms within the crypto asset space. So you've got firms that operate across the world. They're not within one jurisdiction, they're across many jurisdictions with many different regulatory frameworks and regulatory approaches from different regulators. And that leads us to the international standard setting bodies. It leads us to the FSB, to IOSCO. Focusing on IOSCO, there are obviously regulatory principles that they have that have been around for many years. The FCA is leading under the FinTech Task Force, a crypto and digital assets working group, looking at exactly those challenges. What are the nuances of crypto, which means that regulation across the world, across different jurisdictions, goes on the same principles as currently existing, or that there are nuances that needed to be changed. It's a hot topic, and there are many challenges there. But I think the key one is that we need to do this on, and we are doing this on an international basis, as well as looking at our own domestic regime.
If I could just follow up on that, I think it's a fascinating point. Trying to speak to companies which often operate in offshore jurisdictions, the exact nature of their governance is sometimes unclear, there's less transparency in many cases. Obviously, there's a broad range across the crypto world, but even standard setting bodies such as IOSCO, the International Securities Organization, Bank for International Settlements, and so on. Even these organizations struggle to bring these companies to heel. Do you think that that's a fair point of view? And if so, what kind of changes do international regulators need to examine?
So I'm not sure what you mean by bringing them to heel. I think that has to be done by regulators themselves rather than the standard setting bodies. And I think regulators across the world face challenges with, as I say, the international conglomerates. Some of those set out very neatly, I think, in the FSB consultation on stablecoins, highlighting, for example, vertical integration and conflicts of interest. And they're looking at that is something that I think both national and international regulators have to do. But none of this is new. There have been issues around traditional finance, where there are traditional solutions. And I think some of those will read across into the crypto world.
Okay. Andrea, what do you make of all of this in terms of regulation, balance between ensuring financial stability, whether that's in a prudential sense or looking at the interests of individual consumers and so on? The rulebook that we currently have out there that applies to traditional currencies, financial industry, and so on. Is it fit for purpose when it comes to regulating stablecoins? Do we actually need a new set of rules, or can existing frameworks be applied to this technology?
So to me, we have to be very, very clear about differentiating between the product or the service and the technology. And if we are forward-looking enough to think of the system which should see the rise of CBDC as well, well, that should set quite a bit of order into the mechanism, into the system, because CBDC should be supposed to bring cash into the digital world, and therefore allowing this sort of base layer anchor. Now, so I'm a strong believer that there is going to be space for everybody. I do not believe in a full crowding out of the space, simply because I just don't believe, A, the central banks are the most equipped institutions to get into the sort of innovation camp. Central banks tend to have a culture of not making mistakes rather than experimenting. But I can see how CBDC can actually be incredibly useful to create a very solid base layer. in which to build and where the private sector, be it crypto, stablecoins, and so on, can actually leverage to give full potential to their creativity and their ability to satisfy specific needs. So if you ask me at the current state of things, how things could look like going forward, I think that if we imagine the market, because this is going to be a market, it's an industry in the end, of payments as a distribution, or as a normal distribution, I would imagine CBDC to try to capture the center, and then there should be plenty of space in the tails for many different solutions to give full potential to creativity and to actually provide services that CBDC cannot even think of.
It's a fascinating point. And Jeff, what do you make of this? Can you foresee a situation in the future where the ECB digital euro exists in someone's digital wallet alongside USDC, alongside Tether? Can all of these different products coexist? If that was the case, wouldn't it just be too much for individuals or consumers?
I would say that not only can it exist, I would almost go as far as to say that it must exist. And I think we understand why we're not going to have just one global currency. I mean, Europe knows it well enough, because long before Brexit, there was talk of Brexit. If for all of you that remember this back from 2011, and this idea that we're exposing all of the risks associated with having fiscal policy be decoupled from monetary policy and all of the implications of that. So I do think that we are going to always live in a multifaceted, multifarious world where we have different kinds of money issued by different issuers, both at the central bank level, as well as at the stablecoins or bank level. In terms of wallets, well, wallets are just tools that allow us to hold assets. And I would like to suggest that in the future, we will see digital wallets that are very much like physical wallets. They will allow you to hold stuff in them. And this stuff might be pound sterling, it might be euros, it might be dollars, it might be script that has been issued to you by a coffee shop that said that you get a free coffee if you have 10 stamps. It could be anything. So yeah, I do think that's true. And in terms of where the future is going, I couldn't agree with Andrea more when he says that this is going to be a platform, right? CBDC could become, and probably will become, a platform upon which other kinds of value-added services would be added, not to be exclusive, but to actually enable. I think that also is the answer to Tiana's point about central bank digital currency. Not the proposals today don't necessarily use open source or interoperable platforms. I suspect that that's going to change. First of all, I do think that we are a long way to go in the CBDC story. I think that central banks are coming along, but it's going to take some time. I think ultimately we will see interoperable CBDC, and we will see platforms for trading CBDC that allow for the right kind of regulatory visibility, as well as the right kind of possession and control by private actors who are non-financial actors. And I think that really the interesting question is Jane's question about this regulation being same kind of risk, same kind of outcome. Now that makes sense, although I think we have to ask the question very carefully. What is it about CBDC that makes it, or stablecoins that make them the same or not the same as other forms of money? And I think that these different forms of money have different characteristics. For example, both CBDC and stablecoins allow end users to custody the assets themselves without a custodian, which is important. Both of them could be designed to facilitate both strong privacy and strong regulation, which is important, and beneficial to tax authorities, by the way, as well as anti-fraud authorities. But they're different in terms of the risks that are intrinsic to their issuance, as well as their differences versus forms of e-money that are popular today, such as bank deposits as means of payment. And if we look at this as questions for future payment systems, qua future large-scale stores of value, I think we'll start to tease apart the distinctions in terms of use, because there are so many different ways in which money is used, and expecting one solution to rule them all is probably wrong.
Tina, how do you see this in 5 years? Stable coins, you know, will we have everyone in this room sitting with a smartphone in their pocket with USDC, USDT, USD, and a digital euro, all sitting there in different deposits? How do you see the industry playing out in the next few years?
Well, I personally am a big fan of optionality. And as Greg has said, I don't believe that in the future, you know, we are going to completely upend our two-tier banking system, which provides for public and private money at the same time. I think that they serve different use cases and will continue to do so. I am obviously, you know, very long USDC. I think it has a lot of utility. I think we probably have at least a solid 5 years before really operational and potentially interoperable CBDCs are in the wild. And so, you know, there is a service to be provided certainly in those next 5 years that stablecoins can do today. I think one thing that's interesting, if we kind of think to the wallet in your pocket, as Jeff was saying, if I have euros, dollars, and pounds in my wallet, which I often do, I can't go into a coffee shop in Paris generally and pull out a pound and pay for that. But there is this potential, I think, within, you know, the digital asset space where I might be able to very quickly go into my digital wallet and change my digital pounds or USDC for, you know, a euro coin and pay for a coffee that way. And so I think that ability to kind of operate assets that, you know, are designed in the same way. Certainly in this use case, I'm giving you the same issuer, right? So it's kind of one for one, a pound or, you know, a dollar for a euro, and not have that, you know, issue of, oh shoot, I don't have, you know, euros to pay for this taxi that I got in and I thought I did. And now what do I do? So I think the key thing to ensure that we continue to move toward this usage period and away from the speculation, you know, part of the hype cycle that hopefully we're leaving now, is really ensuring that people know how to use these services and making sure that using these services becomes much more intuitive, much more user-friendly, and includes those, you know, consumer protections and disclaimers, and people really understand how to use them. And I think that financial literacy piece is not great today. Right. So, you know, we have a whole generation of people in the UK who are fighting tooth and nail to maintain their free access to cash. Right. ATMs are going away. And this is, you know, a big problem for government. What do we do? And so I think we need to really ready people and bring them along on this journey so that they can use these tools. Because the world is going to change, and it's our responsibility to kind of bring people along on that journey.
Okay, thank you very much. I really wanted today to be able to bolster as much engagement from the audience as well. All these very fascinating topics. I was really hoping to gather feedback from the audience, as well as ask if there are any questions for any of our panelists from the audience today. So please do raise your hand. We'll get a microphone over to you if anyone would like to ask anything in particular. One from there. Oh, actually.
Great panel, thank you. I'm a strong believer, it was mentioned earlier, the optionality to users, that both central bank digital currencies and stable coins should coexist together. But it was also mentioned a few times that, checking my nose in, so what would happen if central bank digital currencies has the following: strong regulation, strong privacy, and strong usage? What will be the sole purpose of stablecoins then?
That's a great question. Andrea, would you like to take first bite at this?
Yes, I'm really hoping that we're going towards a world where CBDC has got the characteristics you are giving. The point is that it is very unlikely to me that one single platform, one single solution will be able to satisfy all possible needs and services. So I'm convinced that CBDC will happen and will capture the kind of center of the distribution, but that there will be plenty of space for banks to continue to do their role and for private agents in stablecoins and in crypto to leverage on the CBDC to develop new use cases, new services that the CBDC is unable to offer. And so it's a better product offering, probably more stable. And I just wanted to add on cash. I have not heard any central bank thinking of launching CBDC to remove cash. So cash should always stay as the optionality alternative that works without internet, without electricity, without anything. And so really having more options is better for everybody. And ultimately the real winner of this is the innovation world and it's the consumer.
From a consumer protection perspective, Jane, can I bring you in here? Is that the case, the view from the FCA and the regulatory community as a whole, that greater optionality and the ability for consumers to choose between different methods of payment, whether it's traditional cash, central bank digital currencies, one day we actually see these as well as privately issued stablecoins? What do you make of that?
So I think innovation is the way to go, but it has to be balanced with consumer protection. You have to have market integrity. I'm sitting here thinking about the CBDC regulation. That is not with the FCA, so I can't comment on that at all. But actually, the more use cases there are, the more ways that people can safely use money, use stablecoin, use digital currencies, then that's fantastic, as long as it is safe and there is consumer protection there. And innovation is the way to go then.
Jeff, I think that you wanted to add something to this.
Yeah, so thank you very much. I think, first of all, I really think that we should see that world that you described with strong regulation, strong privacy, and strong usage of CBDC. And I agree with Andrea completely that that we will never, or maybe never is a strong word, but I would expect that we're never going to imagine that this public utility is going to capture all the possible use cases of money or different forms of money. There are always people creating new ways of issuing money or using money. Think about all of the ways that people have money in the internet. I mean, the Second Life money, and the ways that people use money on airplanes, avios to buy cups of tea or whatever. These are, I think, not going away, and I would imagine that that's part of what innovation is for. Now, we can look at this the way that, say, turnpikes have evolved and say, well, look, stablecoins need to exist now to address niches in the market that don't exist today. Like right now, there is no way for me to make a digital payment using an asset in my possession under my control with privacy at a distance. I can't do that. It's just not possible. So if a stablecoin helps me do that, that will be great. Now, one day, it might be the case that CBDC recognizes, central banks recognize that this is something that needs to be provided as a public utility. And some aspects of that will be, and systems that address those purposes might become public utilities, but that doesn't mean that, number one, it doesn't mean that they'll ever completely replace all of the possibilities of innovation that businesses can create. And number two, it doesn't mean that, that we are intrinsically eliminating the possibility that that there are going to be that there's going to be a continued need for innovation. So I think we do have both, and I think they coexist.
Thank you very much. Does anyone else wish to ask a question? Dr. Pesca, thank you.
Thank you very much. Thank you, Tom, and thank you everybody for this very interesting panel. I have just a, I mean, I was so much inspired by the conversation we had, but you know, in a kind of a futuristic kind of perspective, where we are all living, all connected, there is no problem of connectivity, where everything is interoperable, everything is frictionless, everything is real time. But we don't need well, I mean, I'm thinking, so I would like the panel to help me to elaborate my thinking. Are we moving toward a world where maybe the payment instruments doesn't play much any important role anymore because it's just about an accounting book? And if everything is platformatized or this platformization of the society, and I heard before that this CBDC could become this platform, then if everything is in that platform, really borderless, frictionless, in real time, then we don't really, I can convert everything and just use the same, we can use the same platform. Another question is, if this is the picture, who's going to control this platform? Is the public good service, of course, but is under the control of the states? I mean, there are a lot of questions, but I think some work that the industry is doing and some direction that the technology is taking probably will lead us to a less important role of the payment instruments and a more important role of these platforms.
That's a fascinating question, Andrew. What do you make of that? Do you think that you know, one day we're going to see this kind of situation where platforms essentially have a huge amount of power over how payments are made?
No.
Why not?
And the reason is that we were ideally getting close to that idea with Facebook, and we know how it ended. And the reason for that, and the second data point we've had.
Underlying platform. So underlying platform.
Yeah, but the point is that we have had a second very strong signal this year with sanctions to Russia and the utilization of SWIFT. Now, the launch of digital currencies is, to me, the potential threat to the monopoly of SWIFT and the ability of a government to shut down and cut off other countries from the global payment system. So the payment industry is strategic and is structural, and governments want to have a good grip to it. There's a very strong political angle to it. So my firm answer of no, I cannot see that happening. It's because governments know that very well. They know that it is a national security issue, and therefore they'll want to have a very strong grip to the payment platforms and to, you know, the digital euro. Actually, one of the reasons for it, explicitly given by the European Central Bank, is to increase strategic independence, because right now in Europe, payments rely on American companies. Yeah. So I do not believe that the frictionless global world that you describe will happen.
Jane, can I just bring you in here for your thoughts on that question? Essentially, as Paul points out, this is a real, you know, there's a real philosophical heart to this question of oversight and public good. Everyone uses payments whether you like it or not. At the moment, we rely on governments primarily to oversee this. The future of payments, if there is a degree of platforms emerging as some of the titans of this, the stronger people in this, who should oversee that?
It's an excellent question, and in typical regulator's fashion, I'm not going to give you an answer. It's something that we're very much aware of, though, and it's something that we're working through. I would question, though, whether a frictionless journey is the right journey. Some frictions are good, some frictions are there for a purpose, and I don't believe getting rid of them is one of the objectives we should be pursuing. But I think this is a conversation that needs to happen. And I know for FCA regulation, I can't talk to anything else. We're working on regulation. We are waiting for Treasury to give us powers to regulate stablecoins, and they've promised a consultation on wider regime by the end of this year. But then I want to have a conversation with industry to understand what the implications are and what we should be considering. And I think your question is a very fair question, and one that we will be grappling with over the course of the next year.
We only have about 3 minutes left. I would just really like to bring Tina back in very, very quickly, just to sum up, if you could. As a platform which issues a stablecoin or a token that has some of the characteristics of that, how do you respond to that, to the potential idea that as an issuer of that, you know, the company involved could become systemic?
Yeah, so I think, you know, the initial question on kind of the platforming of our financial activity, to me, that's quite frightening, regardless of who the platform is. And I think that as we kind of look to put much needed, you know, governance and guardrails in place for this industry, but I think equally for kind of the wider technology industry, I think one of the things that the FCA is actually consulting on at the moment is, you know, what role does big tech play in our lives today, and what role should it? And what are the potential risks there? So for me right now, there are definitely ways that, you know, our data is used to either influence our behavior, or certainly monitor our behavior and learn more about us. And that's very valuable for advertisers and potentially for governments. And when I think about, you know, saying that a CBDC would be private, you know, private with and from whom, right? From each other, from the government. And, you know, we've had central bankers say, well, you know, even if we had the power to be able to see what you were doing, we wouldn't use it. And that may be true of, you know, some of our Western market governments, but that might not be true of everyone. And so I do think that for me, I'm going to age myself here, but, you know, I remember when there wasn't an internet. And I definitely think that as a society, we lacked intention around how this technology was going to be utilized by society at large. And I think that as we move into kind of this Web3 environment, it is really incumbent upon us to take a look at what is the role of technology in our lives and our financial services, and where might those intersections become potentially problematic when it comes to bias, when it comes to our privacy, and certainly, you know, our personal sovereignty. And I think, yes, those are very existential questions, but those are things that I think about.
It's a profound question, and unfortunately we're going to have to finish the session now, just because we've run out of time. I'm sure that there's going to be a huge amount of other debate and question around this, but for the moment I would like to thank the panelists very much. Unfortunately we are out of time, and we can carry on with this afterwards. So thank you ever so much to everyone, and thank you for your questions.